Welcome to the Maybe Not So Great Books channel, You Decide. This is lesson 8 of 14, the inflation problem Graham saw coming from The Intelligent Investor, the definitive book on value investing by Benjamin Graham, commentary by Jason Zweig. Everyone says stocks beat inflation. Graham says that's dangerously incomplete, and the data proves him right.
Yeah, I mean, it's basically the single most expensive assumption in the history of model finance.
Right. The idea that because a stock represents a real business, with hard assets, that it automatically acts as this perfect shield against the devaluation of your currency.
Exactly. It sounds so logical, it feels comforting. And Graham essentially spends an entire chapter taking a sledgehammer to that exact idea.
It's interesting you use the word sledgehammer because usually Graham is this very measured, polite, gentlemanly writer.
Very academic.
Right. But in this section, especially when he gets into the data from the inflationary periods he studied, he doesn't pull punches. I mean, he is basically screaming at the reader from 1972.
He really is.
Yeah.
And, we have to remember the context here. When he wrote the final edition of The Intelligent Investor, inflation was literally the wolf at the door.
It wasn't just a theory.
No, not like it was for investors in, say, 2015, where it's just a line on an economics chart. In the early 70s, it was actively eating people's life savings alive.
So before we get into the actual mechanics of how that eating happens, let's establish the hook for you, the listener, the counterintuitive truth of all this. Because if I go to a cocktail party where people talk about asset allocation, which is basically the only kind I go to.
Naturally, you're a fun guy.
I try. But if I say there, hey, I'm worried about inflation, the standard response you always get is just buy the S&P 500. Companies raise their prices, earnings go up, the stock goes up, boom, problem solved.
Yeah, the classic narrative.
Why is that narrative mathematically wrong?
It's wrong because it completely ignores the denominator. It ignores what investors are actually willing to pay for those earnings.
Okay, unpack that.
So the historical data shows this massive contradiction. High inflation often crushes stock prices and business returns at the exact same time. It's not a seesaw where the dollar goes down and stocks go up.
Right.
It's often a trapdoor where both go down together.
You're talking about the correlation failure.
Exactly. If stocks were this perfect inflation hedge, you'd expect a high correlation.
Yeah.
Like inflation goes up 5%, so stocks go 5% plus whatever their real return is.
That's what everyone assumes happens.
But it doesn't. Graham looked at the data from 1915 all the way to 1970 and found absolutely no consistent connection. In fact, during the most severe bouts of inflation, stock valuations didn't expand to match the currency loss. They contracted hard.
Valuation contraction. That is the key phrase we're going to be unpacking today. But first, we need to look at the evidence. And the most damning piece of evidence, which Graham saw at the very beginning of, and Jason Zweig really highlights in the commentary, is the lost decades.
Oh yeah, the period from 1966 to 1982. This is the era that haunts every old school value investor's nightmares. And it's a period that modern investors, at least until very recently, had completely forgotten about.
Let's walk you through the numbers on this, because lost decades sounds sort of abstract. What did it actually look like for a normal person who put their money in the Dow Jones in 1966?
Okay, so picture this. It's 1966, the economy is booming, the Dow Jones Industrial Average hits roughly 990 intraday.
Almost 1,000.
Right. You're feeling great, you buy the index, you hold it. You are the ultimate disciplined, long-term investor.
I'm doing everything right. I'm not day trading, I'm just holding.
You hold for 16 years.
Wow.
You watch presidents come and go. You watch the Vietnam War end. You watch the moon landing. You wait all the way until 1982. You pull up your statement and look at the Dow Jones again. Where do you think it is?
Well, I mean, usually the market doubles every 7 to 10 years, so it should be, what, 3,000 or 4,000?
It was at 875.
Wait, it actually went down in nominal terms over 16 years.
It went basically nowhere. I mean, it bounced around, sure. It hit 1,000 a couple times. It dropped to 600. It went back to 900. But point to point, over 16 long years, the price of the index was effectively flat to slightly down.
That's rough.
But that's not even the disaster.
The disaster is what happened to the actual dollar during those 16 years.
Precisely. That is the silent crash Graham warns about. Between 1966 and 1982, the Consumer Price Index, the CPI, more than doubled.
So the cost of living exploded.
Exploded.
Yeah.
The cost of a house, a car, a gallon of milk, a loaf of bread, it all skyrocketed. So if you had $100,000 invested in 1966 and you finally pulled it out in 1982, you had roughly the same number of dollars. But those dollars bought less than 50% of what they could buy when you started.
That's insane. You lost half your wealth while the market looked flat on paper?
You lost half your real purchasing power. It was this stealth bear market of epic proportions. And this brings us to the really provocative question that Graham forces us to confront.
Which is,
if stocks are such a great inflation hedge, why did they lose half their real value during the absolute worst inflation of the 20th century?
that is the multi-million-dollar question. And to answer it, we have to go much deeper than just market sentiment. We have to look at the mechanics. Graham has a theory about this, and it relates to how inflation acts as a tax. Not a government tax necessarily, but a tax on valuation itself.
Right. This is the core concept of the lesson. We really need to talk about the relationship between inflation, interest rates, and the PE ratio, the price-to-earnings ratio.
Let's break this down, because the gravity analogy is one that Warren Buffett, who is obviously Graham's most famous student, uses all the time.
It is the absolute best way to visualize it. Think of interest rates as gravitational pull. The intrinsic value of any business is simply the stream of cash it's going to generate in the future, discounted back to the present day.
Right, discounted cash flow, DCF. We don't want to get too bogged down in the textbook math here, but the core concept is vital for you to understand. Basically, $1 I give you in 10 years is worth less than $1 I give you today.
Correct, because you could have invested today's dollar and earned interest on it. And exactly how much less that future dollar is worth depends entirely on the interest rate.
So if interest rates are at 0%,
If rates are zero, $1 in 10 years is almost as good as $1 today. The gravity is incredibly weak. So asset prices can just float higher and higher.
but when inflation arrives,
When inflation arrives, the game changes. Lenders demand higher interest rates to compensate for the fact that the currency is losing purchasing power. Central banks step in and raise rates to cool the economy down. So the risk-free REIT, the yield you can get from a safe government bond, shoots up
and that increases the gravity on everything else.
drastically.
Yeah.
Suddenly, that future dollar from the company's earnings is being discounted at 8% or 10% or even 15%. Its present value just mathematically shrinks. This is why stock prices crash when rates spike. It's not necessarily because investors are panicking. It's just the cold repricing of the asset based on a higher discount rate.
So you really have this double whammy going on. Graham identifies this so clearly. First, the future earnings are worth less in today's dollars. But secondly, and this is the behavioral kicker, the PE multiple itself contracts.
That is the actual mechanism of the crash. Think about it. In a low inflation world, investors might be perfectly happy paying 25 times earnings for a really good company.
Because they have no alternative safe yield.
Right. But in a high inflation world, where they can suddenly get 10% risk-free just by holding a government bond, they're not going to pay 25 times earnings anymore. They might only pay 10 times earnings for that exact same company.
So even if the company's actual earnings go up a little bit because they raise prices with inflation, if the multiple that investors are willing to pay gets cut in half, the stock price tanks.
Exactly. Let's say earnings go from $1 to $1.50, but the multiple drops from 25 to 10. 25 times $1 is a $25 stock price. 10 times $1.50 is only a $15 stock price. The earnings went up 50%, but the stock price dropped 40%. That is the brutal math of the 1970s.
But there's an even more insidious element here that Graham discusses. It's not just about the stock price or the multiple, it's about the fundamental quality of the earnings themselves. We need to talk about the money illusion and phantom profits.
Yes. This is a concept that I think is totally glossed over in modern financial media, but Graham was absolutely obsessed with it, and for very good reason. It's about the massive difference between accounting profit and real economic profit.
Let's use a concrete example for this. You know I love a good widget factory example, but let's make it a department store today. Let's say I run the Deep Dive department store.
Okay, perfect. You're the CEO, you buy a nice shirt for your inventory at the beginning of the year, and it costs you $10.
$10 cost.
Now, inflation hits hard that year. By the time you actually sell the shirt, the wholesale replacement cost of that shirt has risen to $14.
Okay.
But because general prices are up everywhere, you manage to sell that original shirt to a customer for $20.
Awesome. I bought it for $10, sold it for $20. My income statement says I made $10 profit. I am a retail genius.
On paper, yes, you are a genius. You report a $10 profit to your shareholders, they cheer, but crucially, you also report a $10 profit to the IRS.
The taxman cometh.
Always. Let's say the corporate tax rate is 30%. You pay $3 in tax on that $10 profit. So you're left with $7 of net profit, plus your original $10 of capital that you recovered. You now have $17 sitting in the bank.
$17. Nice. But wait, To keep my department store open, I have to put a new shirt back on the rack to sell tomorrow.
Exactly. You can't run a store with empty shelves. And what does the new shirt cost you now?
You said the wholesale cost went up to $14.
Right. So you take your $17 from the bank, you buy the new replacement shirt for $14, and what do you have left over?
I have $3.
You have $3 left over.
But wait, my income statement said I made a $7 net profit.
That is the phantom profit. The accounting system told you that you made $7. But in economic reality, after maintaining your basic inventory levels, you only generated $3 of actual distributable cash. The inflation ate your working capital, and then the government taxed you on the inflation.
That is brutal because the tax code doesn't adjust your cost basis for inflation. So I'm paying real hard cash taxes on nominal gains that are just inventory repricing.
Graham literally calls this phantom profit. In high inflation periods, companies will report record earnings on CNBC, but their free cash flow, the actual money they can hand back to shareholders as dividends, completely collapses because they have to pour all that money back into just replacing more expensive inventory and factory machinery.
So Graham's argument is that during inflation, earnings quality fundamentally degrades. A dollar of earnings in 1974 is just a lower quality dollar than a dollar of earnings in 1964 because it requires so much more capital reinvestment just to tread water.
Precisely. It's exactly like running on a treadmill that keeps speeding up. You're expending way more energy just to stay in the exact same place.
This really explains why the whole stocks are an inflation hedge argument is so deeply flawed. It assumes the company can just pass on costs cost-free. But the tax friction and the capital intensity friction act as this massive drag.
And this leads directly to Graham's massive hesitancy about forecasting. He looked at all these moving variables, interest rates, tax codes, inventory costs, consumer behavior, and realized it was just too complex to accurately predict.
Graham is famous for saying, "I don't know."
He is. It's his superpower. And regarding inflation, he's incredibly adamant. He explicitly refuses to predict when inflation will happen or how bad it's going to be. He says, essentially, I've seen brilliant economists try to predict this and fail repeatedly.
So if we can't predict it and we now know stocks aren't a perfect hedge, what is the strategy? Is it just crawl under a rock?
No, it's about robust portfolio construction. Graham's strategy is that you don't build a portfolio to profit from a specific prediction.
Like saying, I bet inflation is coming next year, so I'm going all in on gold.
Right, he hates that. You build a portfolio, his famous 50-50 stock and bond mix that survives whatever happens. You optimize for resilience, not prediction.
We're going to debate that 50-50 mix later because there's a ton of controversy there in the modern context. But let's get to the stories. Because every great lesson lives in its stories. And Graham wasn't writing this in a vacuum. He was writing the 1973 edition of The Intelligent Investor right as the storm clouds were gathering over Wall Street.
He was. And story number one here is really about the Nifty 50 and the total delusion of the one decision stock.
Paint the scene for us. It's 1972. What was the vibe on Wall Street?
It was a bizarre bifurcation. The broader market was doing okay, but there was a specific group of stocks, about 50 of them, that institutional investors had decided were essentially infallible.
The blue chips.
The bluest of the blue chips. We're talking Xerox, Polaroid, Avon, McDonald's, Disney. The narrative on Wall Street was, these companies grow faster than the overall economy. They have infinite pricing power. They are totally immune to the business cycle. Therefore, no price is too high to pay for them.
No price is too high. Man, whenever you hear that in finance, you should run for the hills.
It was fatal. These stocks were trading at PE ratios of 60, 70, 80, even 90 times earnings. I think Polaroid was trading at nearly 100 times earnings at its peak.
Meaning it would literally take a century of their current earnings just to pay back your initial investment.
Yes, 100 years. And Graham, who's this old grumpy master of value investing, looked at this and basically said, this is mass insanity.
He called it out.
He warned specifically that the returns on these high flyers would be catastrophic.
Yeah.
And importantly, he didn't say the companies themselves were bad.
Yeah.
He loved Disney. He loved McDonald's. He said the math was bad.
The valuation offered no margin of safety.
Exactly.
So what triggered the actual collapse? Because they didn't just slowly deflate, right?
Oh no, they crashed. Inflation started to tick up in 1973. Then the Arab oil embargo hit. Energy prices quadrupled overnight. Suddenly, inflation wasn't running at a manageable 2%. It was 10%, then 12%.
And the gravity turned on.
The gravity turned on with a vengeance. Interest rates spiked to combat the inflation. And remember what we said about multiples. When you have a stock trading at 90 times earnings, It is incredibly sensitive to interest rates. These stocks didn't just fall, they were absolutely decimated.
Give me the numbers.
Polaroid fell something like 90%. Avon lost 85% of its value.
Wow. And these were real companies. They weren't .com scams with no revenue. They were making physical film and actual makeup.
They were great companies, but they were terrible investments because the sky-high valuation offered absolutely zero protection against inflation-driven rate hikes. Graham saw that coming when everyone else was partying. He understood that the price you pay is your only true defense.
Okay, so that covers the stock side of the equation, but there's another story here, and it's arguably a sadder one. The silent destruction of the bond investor.
Yeah, this is critical because Graham usually recommends bonds as the safe haven for the defensive investor. But he is intellectually honest enough to show exactly where bonds failed spectacularly. He points to the period from the 1940s through the 1970s.
What happened there?
Well, in the 1940s, we have the Second World War. The government capped interest rates to fund the war effort affordably. You could buy a U.S. savings bond yielding 2.5%. And millions of normal people did. They thought it was the patriotic, completely safe thing to do with their savings.
Right, 2.5% yield. Principal is guaranteed by Uncle Sam. What could go wrong?
It was a safe nominal return. But then inflation started its long, slow march upward after the war and really accelerated in the 60s and 70s. By the time those 20-year or 30-year war bonds finally matured, the real purchasing power of the principal had been utterly destroyed.
So you gave the government enough money to buy a crate of apples, and 30 years later, they gave you back enough money to buy a bag of apple seeds.
Essentially, yes. Graham calls this a slow-motion catastrophe. The bondholder didn't lose money on their monthly statement. The statement always said $10,000, but they lost immense wealth.
Which is why Graham insists on holding some stocks.
Exactly. This is why he says even the most defensive, risk-averse widow or orphan must hold some stocks, some real productive assets. You simply cannot be 100% in fixed income because inflation absolutely guarantees a loss of purchasing power over long periods if your yield doesn't keep up.
Okay, this historical context is incredible, but I think we need to build a bridge for the listener right now, because there's a big gap between Graham's 1970s and where we are today. For a long, long time, basically from 1982 to 2020, inflation just wasn't a problem.
Right. This is the era that economists affectionately call the Great Moderation. And it's crucial to understand this era, to understand why the crash of 2022 was such a massive shock to everyone.
So, 1982, Paul Volcker is the Fed chair. He raises rates to like 18% or something crazy and breaks the back of the 70s inflation.
Yep. And then for the next 40 years, interest rates basically just went down, 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 from 18% all the way to literally 0% in 2020.
And as we know, when rates go down,
gravity gets weaker, asset prices go up, stocks went up, bonds went up, real estate went up, everything went up. It was a 40-year structural tailwind for asset prices.
It lulled everyone to sleep.
It really did. It lulled an entire generation of investors and professional fund managers, by the way, into believing that inflation was permanently dead.
We totally forgot the lesson.
We completely forgot. We started designing these complex portfolios that basically assumed interest rates would stay at zero forever. We assumed bonds were always going to be a perfect hedge for stocks. We optimized for a world without gravity.
And then came 2021 and 2022.
The ultimate wake-up call. The global supply chains broke. Money printing during the pandemic went vertical. Inflation spiked to 9%. And suddenly we were living in Graham's Chapter 2 all over again.
Let's really connect this to the 2026 context that we're living in now. Looking back at that 2022 crash, it played out exactly like the mechanics we just described from 1973.
To the absolute letter. The Fed raised rates faster than at any time in recent history. And what happened? The high-flying tech stocks, the modern equivalent of the Nifty 50, got absolutely crushed. The PE multiples contracted violently.
But the bonds got crushed too, and this is what I want to drill into for a second. We mentioned duration risk earlier. Can you explain the actual math of why a theoretically safe bond loses 20% or 30% of its value just because rates go up?
Sure. It's all about opportunity cost. Let's say in 2020, you bought a 10-year Treasury bond paying 1%. You lock that in.
Okay, I'm getting $10 a year on my $1,000 bond.
2 years later, inflation is raging and the Fed raises rates to 5%. New government bonds are now paying $50 a year.
I want the new bond. $10 sucks.
Exactly. Everyone wants the new bond. Nobody wants your old bond paying $10. So if you decide you need to sell your old bond, you have to lower the asking price until the effective yield matches the new bonds. You have to aggressively mark it down.
So my safe $1,000 bond is now trading at what, $800 on the open market?
Exactly. That is duration risk. The longer the bond the duration, the more mathematically sensitive it is to interest rate changes. In 2022, long-term U.S. Treasuries lost over 30% of their value.
30% on treasuries?
Yes. That is a crash rivaling the dot-com bust, happening in the safest asset class on Earth.
And this is the modern trap we outline in the notes. People genuinely thought long-term bonds were a hedge against stock market drops. But in an inflation shock, the correlation flips. Stocks fall because of valuation compression, and bonds fall because of the rate adjustment at the exact same time.
It was the year diversification failed, or more accurately, the year nominal diversification failed.
So, looking around today in 2026, how do we apply Graham's pricing power filter? If we're in a world where inflation might be sticky for a decade or keep coming back in waves, what makes a company actually survive?
Pricing power is the only shield. But we have to be really specific here. It's not just, can you raise prices? It's, will the customer scream and pay, or will they scream and leave?
Oh, I like that. Give me the scream and pay example.
Enterprise software. Think about a massive hospital network running on a specific patient management system, or a Fortune 500 corporation running their entire backend on Microsoft 365 or Oracle. The vendor raises the price 15%. The hospital hates it. They complain. But are they going to rip out the entire operating system of their hospital, retrain 10,000 nurses, and risk patient data just to save 15%?
No way. The switching costs are astronomically high.
Right. So they scream, but they pay. The software company successfully passes the inflation on, their margins hold up.
And the scream and leave example.
Generic consumer goods, or undifferentiated commodities. Let's say you manufacture basic cardboard boxes, or you make basic steel rebar, or even certain types of trendy clothing. If you raise your prices 15% and your competitor down the street only raises theirs 10%, the customer just switches immediately. You have no moat.
So in an inflationary environment, having a moat isn't just a Warren Buffett buzzword. It's literally the difference between your earnings keeping up with inflation or getting eaten alive by it.
Correct. Graham would be looking for companies with very high return on invested capital, or ROIC, and low ongoing capital requirements. Companies that don't need to build a brand new billion-dollar factory every year just to stay even with last year's output.
If we look at where we are now in 2026, people are paying huge multiples for AI companies.
Right, priced for absolute perfection.
And if inflation sticks around or waves back up again, the discount rate on those projected 2035 AI earnings is going to absolutely crush the stock price today.
It's the nifty 50 all over again if you aren't careful with the price you pay.
Okay, we've been heavily praising Graham's foresight here, but we have to be fair as educators. There are limitations to his advice, especially given the financial tools we have today that he simply didn't have access to.
We do. We really have to address the bond yield disconnect and the missing asset class.
Let's start with the asset class. Graham spent decades looking for a truly inflation-proof asset. He looked at real estate, he looked at commodities, he looked at foreign currencies.
And he generally didn't like any of them. He really hated gold, for instance, because it wasn't a productive asset. It doesn't pay a dividend, it doesn't grow, it just sits there. To him, it was pure speculation.
The factory versus the vault.
Exactly. He wanted to own the factory that produces things people need, but he recognized the glaring problem. Nominal bonds lose value in inflation. If only there was a bond that mathematically adjusted for inflation.
Enter tips B's.
Treasury inflation-protected securities. These were first introduced in the U.S. in 1997. Graham died in 1976. He never saw them.
Break down how they work for someone who's never bought one.
It's actually really elegant. If the consumer price index goes up 5% in a year, the principal value of your TIPS bond is automatically adjusted up by 5% by the Treasury. The government guarantees your real purchasing power, not just your nominal dollars.
It sounds like the holy grail for Graham's specific problem in this chapter.
It really is. Most modern value investors strongly believe that if Graham were alive today, he would replace a huge chunk of his traditional nominal bond allocation with TIPS. They solved the precise problem he agonized over.
So that's a limitation of the text. It's missing a modern tool, but there's also a limitation of the strategy itself, specifically the rigid 50-50 rule.
Right. Graham's default advice to the defensive investor is keep 50% of your money in stocks, 50% in bonds. Adjust slightly based on market conditions, but never go below 25% or above 75% in either one.
That makes sense when bonds are yielding 5% or 6%. That's a living wage for your money. But what about the ZRP era, the zero interest rate policy era we lived through from basically 2009 to 2021?
That was the historical anomaly. Following the strict 50-50 rule when bonds yielded 0.5% was incredibly painful, because with inflation at 2% or 3%, you were guaranteeing a negative real return on half of your entire net worth.
You were literally locking in a slow loss.
Yes, and this leads us to the big debate in modern value investing. The cash is trash versus the dry powder debate.
Let's engage this, because I feel like there are two very strong sides here, and listeners are probably torn on what to do right now.
Let's frame it out.
Side A is the Graham purist, they say. I don't care if bonds yield 0. I don't care if cash is losing 3% a year to inflation. You hold the 50% defensive bucket anyway. Why?
Because optionality. The purist argues that cash isn't an investment. It's an option ticket. It's the dry powder you need to buy stocks when they inevitably crash. Think about it. If you are 100% invested in stocks and the market crashes 50%, you have zero money to buy the lows. You can't take advantage of the fire sale.
So the cost of holding cash to the inflation loss is simply the premium you pay for an insurance policy and the opportunity to act later.
Exactly. And there's the psychological benefit. If you are 50-50 and the stock market drops 50%, your total portfolio is only down 25%. You are vastly less likely to panic and sell at the bottom.
Okay, that's the purist defense. Now let's play the modern critic. Side B, they say. Graham was permanently traumatized by the Great Depression, which was a deflationary crash. We live in a fiat world where central banks print money forever. Holding 50% cash is a guaranteed way to go broke slowly.
The famous cash is trash argument. Ray Dalio talks about this.
Right. They would argue that if you held 50% cash from 2010 to 2024, you massively underperformed. You missed the greatest secular bull run in history. Inflation ate your cash and stocks ripped higher. The opportunity cost of the cash was devastating.
And they're mathematically correct, historically speaking, over that specific 14-year period. In a massive bull market, cash is a terrible drag. In an inflationary bull market, cash is an anchor around your neck.
So who actually wins this debate?
It entirely depends on your personal timeline and your psychology. The modern critic is absolutely right. If you have a 30-year horizon and literal nerves of steel, if you can watch your life savings get cut in half in 2008 or 2022 and just sit on your hands and not sell, then being 100% equities is mathematically superior over the long run.
But Graham argues that nobody actually has nerves of steel when it's their own money.
Exactly. Graham is ultimately a behavioralist. He knows that when your portfolio drops 50%, you don't casually look at a 30-year historical chart. You look at your spouse across the kitchen table and say, we just lost half our retirement, and then you panic sell.
So the 50-50 split is really a mechanism to save you from your own worst instincts.
It is. It's a sleep-at-night tax. You agree to pay the inflation tax on your cash pile so that you can sleep securely and not capitulate at the exact wrong moment.
That's a really helpful synthesis. It's not about maximizing your spreadsheet return. It's about maximizing your actual survival in the game.
Survival is the ultimate prerequisite for success. If you wipe out emotionally and sell, you can't compound.
Okay, let's wrap this up with our takeaway. We always want to give you, the listener, something incredibly concrete. You've heard the history, the math, the horror stories from the 70s. What do you actually do on Monday morning?
I think we call this the inflation defense audit. It's 3 practical steps.
Step 1.
Audit your PE exposure. Go look at your stock portfolio or your 401k. Do you own mostly expensive, high-growth, high-multiple stocks? Are you betting on PE expansion to make money? If so, understand that you are massively short volatility and you are entirely exposed to an inflation shock. You need some ballast in there. You need companies with real strong cash flows today, not just promises of cash flows in 2035.
Step 2.
Audit your bond duration. This is the painful lesson of 2022. If your so-called safe bucket is full of long-term bond funds, you are taking a huge uncompensated risk if inflation spikes again. Look at short-term treasuries T-bills or look at TIPIAs. Don't just blindly buy a total bond market index fund and assume your money is perfectly safe from rate hikes.
And step 3, the classic Graham rule.
Mechanical rebalancing. Do not try to predict what the CPI print is going to be next month. You will fail. Instead, set your target allocation, whether it's 50-50 or 60-40 or whatever, and stick to it mechanically. If stocks run up huge, sell some of them to buy bonds. If stocks crash, sell your bonds to buy the cheap stocks. This automatically forces you to buy low and sell high, regardless of what the terrifying inflation headlines are saying.
It totally removes the emotion from the moment.
It removes the prediction and the emotion. And that really is the essence of being an intelligent investor.
I think that's the perfect place to land today. Inflation is a silent thief. It's tricky. It masks reality with phantom profits. But if you focus relentlessly on valuation and keep your bond duration in check, you can survive it. That was lesson 8 of 14 on The Intelligent Investor, the definitive book on value investing. Subscribe for the full series. If you haven't seen our debate overview of the whole book, check that out, link in the description. Thanks for being here. See you next time.